Hello, good morning and welcome to ET Now, Buy Now, Sell Now with me, Varun Hiremat and Karunya Rao.
Okay, looking at the markets, then you have the Nifty slip further down. It's right now lost about 113 points. The Sensex is also lost in the excess of 300 points, trading at 37,807 at the moment. Broader markets also equally bleeding right now. There's mid-cap index, which is down 1.1%, and small-cap index is also close to 1% lower. All the sectoral indices are firmly and deeply in the red, barring a few names from the Nifty IT pack, which is right now trading completely flat. All the other indices are witnessing a significant amount of pressure and some profit taking as well on back of the massive rally that we've been witnessing all of these days. Nifty Bank down 2.8%. You have Nifty Metal fall 2.6%. PSU Bank Index is down 2.7%. Nifty FMCG is down 1.5%, and similar quantum of losses coming in for the Nifty Auto. Only 6 stocks are managing to hold it in the green, hold their head above the water. Barring that, all the other names on the benchmark index are in the red. You have ICICI Bank lose most, right now down 4.9%. Hindalco down 4.5%. Z Entertainment ahead of its numbers, sulking in trade, 4% lower. Axis Bank is also down nearly 4%. SPI, UPL, GAIL, these are some biggest drags as far as the index is concerned. Okay, addressing really quick the BNSN stock cloud as well. We've highlighted some stocks that you need to focus on today's trading session. Interestingly, some of them are actually gaining in trade and bucking the market pressure and market trend at large. First up, you have a Reliance flying in trade. It's up a good 3.4% on a day when the entire market is in the red. Sun Pharma, another big gainer, up nearly 2%. Another stock we'd like to flag off that's bucking the trend very, very smartly. On the flip side, you have an Axis Bank, like I flagged off, sulking in trade, one of the top losers on the index. Asian Paints, ahead of its numbers, also under pressure as we speak. The quantum of losses, well, close to 2% for Asian Paints. You have a JSW Steel, another heavyweight. This one from the metals pack, also bleeding a tad bit. I would say it's actually down 2%, not a tad, but quite a bit. 2% down for JSW Steel ahead of its numbers. On the flip side, you have some numbers from the broader names from the broader market that are really outshining and outpacing the market momentum at large. You have a EU Small Finance, stellar set of numbers, very strong rally coming on this counter. Repco Home Finance, strong numbers once again, 5% higher as we speak. PNB Housing as well, soaring in trade on back of their numbers. Rossari Biotech, yesterday after making a fantastic debut on the bourses, continues to move up. Right now in focus also on the back of some fund action. You had Goldman Sachs buying close to 5 lakh shares in the company. Another earnings candidates from the broader market that we'd like to flag off is Agrotech Foods. Good numbers, great operating performance. The stock is flying in trade.
All right, thanks for that, Karunya. ICICI Securities posted their results recently. We're now joined by the management, Mr. Vijay Chandok, who's the MD and CEO. Good morning, sir. Welcome to the show. It's been quite a good quarter for you yet again. We have 2 questions. You know, while other businesses, are facing disruption, work from home has augured well for your industry with higher participation from non-institutional investors. So what were the other factors that contributed to this strong growth momentum? And secondly, can this sustain?
Indeed, these are strange times. And times like this, what we've seen is unusual participation in the equity markets. We saw some very active participation in the equity markets, particularly by the retail investors. And one of the reasons why we've been able to do what we have done in this quarter is, I would say, a lot of efforts of the last several periods of time. When we unleashed our strategy, we have clearly said that one of the important levers of strategy is to create scale and prepare the organization to become a comprehensive solution provider, financial services solution provider, meeting life stage financial needs of our customers. So in line with that strategy, we've been putting a lot of, I would say, input parameters. We've been working on them. We got a lift of the market, and I believe that the efforts of the past, which is increasing granular number of customers, which is working on improving customer experience, which is increasing our product width and breadth, adding new kinds of plans that we have offered, which are pretty unique. Our Prime plan, for instance, is a pretty unique plan where we give instant liquidity when you sell your shares. Otherwise, it typically takes 2 days. And some of our plans on the option side, the FNO side, which is a 20 rupee plan that we've come to options 20. I think they have, these are things that have worked well with the investors. The market opportunity was there. We were ready, and we were able to take the opportunity that played out during this quarter. So I think we should look at it only from that point of view. And the second part of your question is whether indeed this momentum will continue. I think it would be fair to say the reason why this momentum probably came, there are several reasons for it. If you look at the reasons, probably it's a combination of the fact that equities were very attractively sort of poised when this momentum started. In terms of attractiveness, it was really compelling. Then this was one way in which investors could actually enter the markets without necessarily having to have a physical engagement. Everything is digital. You can sit at your home. You're actually in a work from home mode, so you have extra time available at your disposal. So you're having access, you're having time, and you also have a situation because of the lockdown, your discretionary spends are sort of curtailed. So you have your financial resources as well. And then let's not forget there is that uncertainty kind of a factor which is also playing out in the investor's mind as to what is going to happen. And whenever there is that uncertainty factor, there is a fear which drives people to start thinking about savings, investing. So a combination of all this coming together, attractive valuation, availability of time, access without needing of a contact, disposable surpluses sitting with you, and that kind of a mental sort of a fear that should I not be using this disposable stuff for savings and investments, actually probably led to all this kind of a thing. So going forward, whether this will continue, I think it would be fair to expect that these are the factors which brought this growth. There should be some moderation going forward. Having said that, we have always seen that whenever there is a kind of an episode of this nature, which sort of propels greater participation of retail investors in the market, even once that episode is sort of settled and behind us, even though there is a moderation, it tends to settle at a slightly higher level of the base itself sort of gets reset post the sort of episode. So if you were to go by those past experiences and trends, I think it would be reasonable to expect, yes, there will be moderation, but the new normal, so as they say, could be at a slightly better level than what we saw prior to the episode itself.
Hi, Mr. Chandok. Want to understand, there's been a sequential drop in the customer additions during the quarter. Can we say that Q4 of FY20 was an aberration? If you could also tell us, how do you see the retail category in terms of new customer additions in July so far? How's it been?
Elaborate this a little so that you can get a better perspective of the specific outcome that we saw in our company. Prior to the pandemic, our acquisition of customers had a phygital process. So there was a fair amount of digitization, but there was a physical component which was compulsorily required to actually conclude, the acquisition of a customer. When the lockdown was imposed, clearly the phygital part was something that could not be executed given inability to access customers. So it meant that even that physical part of acquisition had to be digitized. So we actually got into a process of working towards digitization of that physical left out leg, which included a regulatory consent, the development of the process on the digital platform, not only at our end, but also at the end of the depository. So we work very closely with the regulator, the depository and our own tech teams, and put together a solution which enabled the process becoming completely digital. So all this actually meant that we had a process which was effectively in place only in the later part, I would say, of April. So there was a fair amount of time when all this work was happening, where acquisition was in some sense a standstill. So what we really are seeing in this quarter is a consequence of the scale up that started post the migration to this model. That's point number one. The second point that we are seeing really is the fact that one of our principal acquisition channels has traditionally been our banking partners, the ICICI Bank partnership that we have. Given the lockdown, certain components of the sourcing from the banking channel itself or into the banking channel was sort of impacted because of lockdowns there. So we were working on, in those areas that were open, those opportunities that were open. And as things are normalizing that, that channel is also coming back to, I would say, the regular rates. The bank channels have started showing a fairly smart growth, which is reflected in the fact that, now close to 35% of our sourcing is actually coming from those channels. Earlier, this was less than 20%. So rather than thinking about Q4 as an aberration, I would think Q1 was an aberration because of the reasons that I explained and the transition sort of issues that we had to deal with in this quarter. So that's how we have experienced the sourcing part of it. Having said that, in the month of June, when things are getting close to regular and normal, the acquisition that we are seeing with respect to our customers have actually in the month of June surpassed our average acquisition that we did in the last year. So that's an encouraging sort of outcome that we have seen. Our effort is clearly to smoothen things up. Our effort is clearly to continue to diversify and broad-base more channels of acquiring customers and to actually increase the pace of acquiring customers. So that's where our attention and effort is going.
All right, Mr. Yadav, and just one final question from us this morning. You mentioned earlier that the credit and banking scenario remains pretty weak. So how much of your revenue is currently coming from the banking channel? And lastly, how do you see the channel mix shaping up going forward?
Until the month of, I would say, February, 100% of a customer that was acquired by our company had to be a bank customer, right? So that was the format of business in which we were operating. So therefore, it would be fair to say that whatever revenue the company has been earning is all coming from those customers who are also a savings customer of the bank. It is only in the current quarter in some measure that we have started in a way pivoting to an open architecture format, which is giving us access to a customer which need not necessarily be an ICICI bank. So we are in a very, I would say, beginning stage of our journey in creating, a franchise of an open architecture network. It is our sort of articulated strategy of diversification and granularization. So in a few quarters to come, we would want the other channels, namely the digital channel, namely our partner network channel, namely our own acquisition channel that we have through our RM and branch network. All of these to sort of scale up at a much higher pace than we have been sort of doing in the past. In fact, some of these channels, for example, the digital channel never existed till now, to start becoming a meaningful size. And our sort of endeavor is to actually substantially grow the new channels, so to speak, to become a really meaningful part of our acquisition strategy and acquisition. position.
Okay, Mr. Chandok, thank you so much for taking time out to chat with us. Let's shift gears and bring on board our guests. We have Sharmila Joshi as well as Kunal Bothra joining in. Morning, everyone. Kunal, coming to you for your top trading ideas. Which stocks are on your radar today?
Well, I'll mix it with the buy and a sell, and finally the markets have shown some signs of correction. So I'm expecting that maybe we could go through a bit of a choppy ride over the next few days and few weeks. So one buy and one sell, and the buy is a contra buy. It's a buy on ICICI Bank. So the stock is down, I think 3.5 or 4%, so far. But I believe at current levels of 375, it's tapped back into a very strong support zone. There are some option-based support levels which have arisen for ICICI Bank at these levels. So it could be a good contra bet at current levels. 390 is where I would place the immediate targets and stop loss to be kept at 366 mark. The second would be a sell on DLF. That's been one of the weaker stocks. We've seen how the real estate pack overall has gone through that corrective phase right from the month of March as well. And I think even at current levels of 137, 138 on DLF, it looks to be more of a shorting candidate. So would recommend a sell over here, targets to be kept at 130 and stop loss 141.
Okay, hi Sharmila, morning. What are your bets in terms of wealth creation, stocks we can invest for the long haul?
Yes, the first stock that I'm going to talk of is Granules India. And, as we can see, the stock is at a 52-week high and it's had a stellar run ever since they declared very good Q1 numbers. And my take on it is very simple. I think, you're sort of focusing on a stock which is, there is a good demand for some of the APIs that Granules has a big presence in, which is paracetamol, ibuprofen, etc. And that could sort of drive revenues for them in this sort of pandemic era that we're living in, because there is good demand for these APIs. And going forward, they have a good strategy in terms of the molecules that they have lined up. They switch to molecules which make better margins. So that revenue stream also looks good for the coming couple of years. So I think this is a stock that you can look at, and the target would be closer to 325, 330. Another stock that I want to talk about is Gujarat Gas. We have been seeing that the whole gas distribution as a space has been seeing a lot of action from the start of the year for various reasons, largely because of some of the decisions that PNGRB took, and they have opened up licenses for city gas distribution, for instance, and a whole host of measures, with regards to gas exchange, and a lot of changes happening on a fundamental basis where that is concerned. So obviously Gujarat Gas stands to benefit from those. And I think if you saw in the numbers, what really paid off for them was the fact that NGT stepped in, the board for the National Green Tribunal stepped in, and they banned all the ceramic units in Morbi which use coal gasifiers. And the result of that was seen immediately in Gujarat Gas's numbers, because you saw that jump in revenue that came because of this. And going forward again, they are talking of 3 more clusters like this in Gujarat, which would be made to shift from coal gasifiers to natural gas. So this entire shift to cleaner gas, that also will play out very well for Gujarat Gas, because as reports suggest, there is a good demand for cleaner fuel that will play out in the coming years, especially where power and other industries are concerned. Transportation will also play its bit, but the main impetus could come from industries. So that's a reason I think to like Gujarat Gas, because they're nicely placed to take advantage of that story. So once again, I think the target here would be closer to 325, 350.
Okay, great, Sharmila. Thanks. Just one request to both our guests. We're running a bit short on time today, so if you could keep your recommendations as short as possible or your advice as short as possible and to the point, that would be great. With that being said, let's get on our first query. Nitesh Kumar. And Dixon Tech and Amber look like good long-haul bets, he's asking. And please suggest fair ideas for long-term returns. So, Kunal, how are those two charts looking for you?
Yeah, both of them looking attractive. Dixon Tech, of course, has done exceptionally well. Amber is just about trying to grapple through or recover to what it lost in the month of Feb and March. So it's not recovered fully as said, but I think it's showing signs of good volume and price pickup. So I think if you're a long-term investor, you should hold on to both the stocks. They both look strong potential. So there's this repair process which is going on for Amber, which I believe could probably be over the next couple of quarters, and post that is where I believe a bigger trend could happen for Amber. So both these stocks is where I would recommend a hold.
Okay, thanks for that, Kunal. And Sharmila, what's your view on a Dixon and Amber?
I would concur. Broadly, there is a similarity between both the plays in the sense that both are sort of contract manufacturers, and clearly market is liking this as an idea at this point in time when they see that perhaps companies would be slow in capex or increasing their capacity, and they would turn more and more towards contract manufacturers to meet extra demand if there is any. And while Dixon is more sort of more of a mobile and maybe now increasingly a television sort of a contract manufacturer play, Amber is pretty much an air conditioner play, and it is very well placed within that contract manufacturing of air conditioners. I think they are contract manufacturers for almost 16 air conditioner brands. So between the two, I prefer an Amber simply because of the valuations. But the market clearly seems to prefer Dixon as a story. So I think yes, both are holds for now. And if I had to buy at this point in time, I'd probably buy an Amber.
All right, moving on to query number 2, then Nageshwar Rao has tweeted to us. He wants to pick up shares of Tube Investments. The stock, he says, has recovered a fair bit, as we all can see, from 250 odd levels, right now trading at 500. He says, what is a good level to dip into? Kunal, your view?
Yeah, I think it's doing exceptionally well. Currently, I think the last 7, 8 years, 10 years have been just about exceptional for Tube Investment. Trading at 790 approximately, if I'm not wrong, at current levels. And I believe in terms of levels, you can probably look at 740 as an immediate support. There are some averages as well as indicator and price supports which sort of coincide at the 740 mark for Tube Investment. So I think it's a good stock on the long-term charts. I'm not sure on the fundamentals, as such for the stock. But then if you're looking at pure levels and expecting that this trend would continue from a longer-term basis, then I believe closer to 740 could be a good starting point for you.
Sharmila, how about you? What's your view on Tube?
Honestly, the last quarter numbers weren't anything to write home about. And probably that is the reason why the stock has dipped, because we saw a steep fall in their profitability. And I think it stands to reason because all the segments that they cater to would have seen a slowdown because of the lockdown. So that said, I think, it's a sort of a cautious view on Tube because you don't know how soon these sectors that it provides to are going to recover, because only then you will see that getting reflected in their numbers. So at this price, very honestly, it looks fairly priced simply because the outlook is not the best at this point in time. We really need to see how the ending of this lockdown really pans out for sectors like the ones that Tube Investment caters to. So if you haven't hold it, but I wouldn't buy fresh.
Thanks, Sharmila and Kunal, for joining in and for addressing our viewer queries. Slipping into a break here, plenty more on the other side. Stay tuned.